The rate of growth, the rise over run, was the fastest in history. And that spooked investors. So investors took money out of the stock market and started putting in bonds. And at the same time, when the monies became difficult to get because interest rates were high, things started to become cooler, right?
Dear friends, this is Vinney Chopra. Thank you for liking the podcast and all the shows. Vinney and Walter, we do that Abundance Mindset show, which goes live in all social channels on Thursday at 9 a.m. Pacific, and also Vinney and Bo show, which goes also on Friday at 9 a.m. Pacific. And thank you for really liking the books and all the content that my team puts out for you. Please enjoy this episode. Thank you again. Thank you so much. Hi there, guys. This is Vinney Chopra back with my great friend Amit Chandan. If you have not seen our episodes from before, like 2-3 months back, we just published it again on the Desi Money Show. Please go back and see what a tremendous knowledge guru Amit is on stock market and volatility and what's happening in the economy and how it's going to really shape up 2024 by December with the election year right here in USA. So Amitji, welcome to the show. Welcome. It's such a pleasure to have you.
Thank you, Viniji. Thank you. I think, market has been reacting in an amazing way. Some people who know how to, or the people who know how to take advantage of this market must be very happy. But those people who don't know what's going on, I have a session packed with knowledge for you all today.
Oh my gosh, can't wait, can't wait. It's going to be very exciting, guys. If you're in the car listening to us, please look at the video edition on the YouTube channel and all over so that you can really get the most of it. So please share your screen, Amitji, and we can dig right into it. Yes.
Perfect. Can you see my screen?
Anji, bilkul, bilkul.
Perfect. So folks, my name is Amit Chandan. Thank you, Viniji, for bringing me back. So today is August 13th. And I'd like to do a market analysis and show you guys what's been actually happening behind the hood and what I expect is going to happen for the rest of the year. And if you guys want to watch my market analysis, I regularly release these every month. So before we get going, please read this legal disclaimer. Remember, I'm not selling anything, and what I'm about to share with you are just my views based on my research. So since July 17th this year, the market has taken a dip, right? And the market dip accelerated on August 1. Now, as of 5th of this month, which is August 5th, the S&P 500 index had gone down by 9.7%. And remember, S&P 500 represents a collection of 500 largest companies listed in the stock exchanges in the United States. NASDAQ, that has more than 3,000 companies listed in it, and that are mostly technology companies, ended up dipping by 15.7%. And Russell 2000, which is a collection of 2,000 smallest to mid-sized companies, went down by 13%. Wow. Now, obviously, we can't forget crypto. But as you all know, crypto is highly volatile. Since July 29 this year, Bitcoin, which is a major cryptocurrency, went down by 29%. But as you can see, Bitcoin has had a downward trajectory since March last year. So if you notice, it's just been going down and down. And since March to this point, the Bitcoin currency went down by 33%. Those of you who have been hoping for this to go up and may have invested in March, April last year have not seen their wealth grow. It's actually going down. And I'll discuss several reasons why this has happened. Now, another very popular cryptocurrency is same thing happened in Ethereum. Since July 22nd, Ethereum dropped by a whopping 40% until August 5th. But since March of last year, till the 5th of August this year, it had dropped by 48%. So clearly, Viniji and everybody else, something has been happening in the market that has brought this volatility.
Yep.
So what are these reasons? And I'm going to explore those right now with you all. So first reason is that last week, US job data for July came in and the employment rate fell below the consensus and the unemployment rate increased by 0.2% to an amount which is 4.3%. So although overall it's going down, but in the last little while, it's been increasing. So last month, the unemployment rate was sitting as 4.3%. But a recent study by Fitch, which just came out a couple of days ago, said that the jobless rate was largely driven by workers joining and rejoining the labor force rather than a meaningful job loss. And permanent job losses are still contained, only making up less than 20% of the increase in unemployment rate. Okay? So these are people going in and out. Now, while hiring rates have slowed down meaningfully, layoffs remain close to a 20-year low, which is a good news. And this triggered a recession indicator called the SAM recession indicator, which in the past has been accurate predictor of recession by 100%.
Oh, wow.
So when people are like, hey, this thing has been correct 100% of the time, and it got triggered again, oh my goodness, there was a panic all over. So I'll show you that indicator. And interestingly, this indicator is available in the US government's website. So this indicator, which is called the SAM recession indicator, it signals the start of a recession when the 3-month moving average of the national unemployment rate rises by 0.5% points or more relative to the minimum of the 3-month averages from the past 12 months. But this time, this indicator was triggered by an increased labor supply rather than the unemployment rate, making this a false positive. And this indicator is actually made by this lady named Claudia. So when people asked, okay, Claudia, Sam, what do you think? This is what she said. She says, our understanding of what is happening right now is so very challenged. And what that means is, and I will be the first to say it as someone who has this rule attached to her name, don't just rely on one tool. She says, don't just rely on one tool. She also says, we are not in recession now, contrary to the historical signal from the SAM rule. But the momentum is in that direction. A recession is not inevitable, and there is a substantial scope to reduce interest rates. So what she's basically saying is, don't just rely on this one indicator that I have. You got to look at other things. And she's saying, recession is not inevitable. Like, a recession may not happen. And she's saying there are certain things you can do. Now, remember, in order for recession to take place, right, certain things have to happen in the economy. What has to happen? The GDP has to continuously fall. But here is the GDP of the United States. This is the Q2. But if you notice, the 3 quarters before, the GDP was going down, right? It was going down. But from Q1 to Q2, GDP started to rise. So if GDP is rising, that doesn't show there's recession coming, right? And the GDP in the second quarter reached 2.8% growth in the US.
Yes.
Even though it was shrinking before, but then it ended up raising. Now I'm going to show you these charts that I have of what happened with inflation in 2021 and continued till 2022, right? In 2021, inflation started increasing right here. So inflation started increasing, leading to a rise in the price of goods and services. And to curb inflation, the Federal Reserve came in and said, we need to do something. Right? What had happened before was there was too much free money. Why was there too much free money? Because the interest rate was almost zero. So when the interest rates were almost zero, that means people were taking money and investing in all kinds of things, right? They could be going on vacation. They could be investing in consumer goods, right? So when money kept flowing in the market, that means the demands of general goods and services increased. And when the demands of goods and services increases, then the businessmen come and say, let's raise the price, because they're going to make more money. And when they make more money, things become more and more expensive for consumers. So that's exactly what started happening. Inflation started to go because things just kept getting more and more expensive. So Fed said, we need to cut this. We need to stop. We need to halt this sudden increase in prices or continuous increase in prices. So they have a few tools in their toolkit. And one of the tools is interest rate. So they said, we're going to start increasing the interest rate. So from practically zero, they started raising interest rates. Now, interest rates had been this high in the past, but what happened, which was unique this time, was the rate of growth, the rise over run, was the fastest in history. And that spooked investors. So investors took money out of the stock market and started putting in bonds. And at the same time, when the monies became difficult to get because interest rates were high, things start to become cooler, right? And inflation start to go down. Because the money supply goes down, small to medium-sized businesses that depend heavily on debt can no longer afford the debt. So when they can't afford the debt, they stop taking debt. And then suddenly the projects and programs that they would have otherwise spent money on, they stop spending that money. And then unemployment rates start to go high. And when that happens, people become nervous and they say, let's not spend money. And when they stop spending money, then the demand for things goes down. And the supply increases and the price goes down. And that's exactly what happened. So United States inflation rates started to go down. And United States' goal was to bring the inflation rate to 2%.
2%, yeah.
So they came, as of last month, came very close to that, which means what they're hoping to achieve was actually working, right? So here I have a chart that shows the consumer price index. So last month, the consumer price index, for the first time ever, hit negative territory. Exactly what the Feds were hoping to achieve. March, it came to a certain height. April, it remained the same. May, it went down. June, it was zero. And then in July, it went to negative territory, which was fantastic. And CPI is monthly. So as of July 11th, this is what it was showing. And when you annualize that, the annualized inflation rate came to 3%, which was absolutely fantastic. So the figures, when you look at the economy, is actually showing good signs. But now, what's going on in the market is the investors and people in the market are saying, maybe Feds took too long. Maybe Feds should have lowered the interest rates some time ago. And you know what? If the figures that we got in August of unemployment rate in July, because they come 1 month later. So if those had come a month prior, maybe the Feds would have lowered the interest rates already. But they just got the unemployment figures. So now they're acting. And then the predictions of the rate cuts have now changed drastically, which I'm going to show you. Now, interestingly, countries like Canada were already foreseeing this, and they had started to cut their interest rates starting June this year. So in Canada, I'm in Canada, our interest rates had already been cut, and there are projections of these being cut in the future. Now, same thing is going to replicate in the United States. Dip in the beginning of August was, did you know that Japan, which is one of the major economies in the world, has a very strong banking system, right? We all know that. But did you know that the interest rates of Japanese yen, which is in the yellow line, had been practically zero since the year 2008? Free money.
Until just now.
Until 2 weeks ago.
I
so
did
what
not
many
know
people
that.
were doing, many traders are like, oh, great, here's an arbitrage opportunity. What they would do is they'd take a loan from Japan and they would invest in the United States economy. So in the stock market, in the bond market, et cetera, and the crypto markets. Because they get free money from there. And they're like, okay, we'll put money here. And the American, I guess, equity and debt market had been very strong. So they were making money. So something happened that removed this arbitrage opportunity. Because money was so freely available in Japan and people would borrow this, Japanese inflation kept growing. They were like, we need to curb this. So here's the CPI. It was growing. And then although it went down, but it started to grow again. So the Bank of Japan says, that's it. No more. We're not leaving this money for almost 0% interest. So they said on 31st of July that we're going to raise interest rates. So no longer is it going to be 0%. And guess what happened on the 1st of August? People who had taken money out from Japan, they're like, oh my goodness, now I have to pay money. This arbitrage opportunity is going away. So they started taking money out of the US stock exchanges and the bond market and the crypto market and put back in Japan. Consequently, the Japanese yen grew in price. And because most of a lot or a big portion of the trading happens through algorithmic trading. So these bots, when they saw suddenly money being plucked and sales are happening in the equity market, debt market, and the crypto market, these bonds started to sell and a ripple effect occurred. And when the ripple effect occurred, the market took a dip. And that's why I showed you that since August 1, market took a sudden dip. And it happened heavily in crypto market as well. But remember, cryptos are heavily volatile. But it happened in NASDAQ. It happened in S&P 500. And S&P 500, because it has 500 of the largest companies, it had the lowest dip. NASDAQ had larger, and crypto markets just had crazy dips. So this was the other reason. In 2022, as I mentioned, the Feds raised interest rates at its fastest to defeat inflation. But now that the inflation is on a downtrend, the central banks can remove those brakes and press on the accelerator to increase the economy. And how do they do that? By lowering the interest rates. So Feds are now looking to cut interest rates. I had mentioned last month that I view 3 cuts happening this year.
3,
right?
yeah.
And now, as the time comes closer, those are starting to become more evident. And I think there's a possibility that if the unemployment rates keep coming out stronger, which means the employment gets weaker or this next month for the month of August, then I think they're going to deteriorate. They're going to probably do a cut of 50 basis points. And the 50 basis point may continue occurring if the economy continues to remain weak. But if the economic signs show signs of strength, then it's going to be 25 basis point, and that may continue. We have to see how it happens or to what numbers it happens, but it's invariably going to happen. But the forecast now for the longer duration is the following. So the rate cuts will continue happening. I think I'm projecting about 3 this year. So 1, 2, 3. And then thereafter, they're going to continue happening. So all the way till the middle or end of 2026, I think the Feds are going to continue cutting rates and come below 2%, which is good news for real estate because as the mortgage rates go down, real estate prices go up. And in the same way, as the money becomes more available, businesses can take loans and start injecting in their businesses. And that that pushes money in the markets, demand goes up, and the stock market also goes up, which means good times are about to come. But you got to know how to play this game. Otherwise, people will continue losing money. So here's what the Fed Watch tool is now saying. Currently, the interest rates, as of now, as of today, are between 525 basis points, 525 to 550 basis points, right? Now, as of today, and I took the screenshot this morning, as of today, on September 18th, when the next FOMC meeting occurs, there is a likelihood of the Feds cutting interest rates by 25 basis point to 500 to 525, and the probability is 50.5%. But remember earlier I was saying that if the economic indicators keep coming out weak, then they may cut out 50 basis points. Guess what? While 25 basis point cut is 50%, the chances of cut by another 25 point is also 50%, which is 49.5%. So there's a probability it may cut to 475 to 500 basis points, bringing this reduction potentially to 0.5%. And that's looking in September. Now, let's fast forward 2 more months to November. And in November, there is a potential of a rate cut by 39% to 475 to 500 basis points. So if it doesn't happen here, it's going to happen here. But at that time, there is a higher probability of a rate cut too, by 49.7% to 550 to 475 basis points. So that's going to be a reduction from today, a potential of a reduction of 0.75%. Okay, now let's fast forward. Remember, I was saying there's potential for 3 rate cuts. So in December 2024, there is a 46.8% probability of rates coming down to 425 to 450 basis point, which from today brings it to minus 1%. Like I said in the 2 slides ago, these rates are expected to continue going down because now Feds have a very important job. Their job is to make sure the economy stays not too hot, not too cool. It stays in the Goldilocks zone. So because inflation increased so much post-COVID, they had to put brakes by increasing interest rates. Now they got to press on the accelerator.
Yes, so true. This is so in alignment with I've been reading also. And thank you so much for really showing so nicely the whole progression. Hey guys, if you missed any part of it, I would highly recommend that you go back on the video edition of our podcast and the show so that you could really see what, and Amitji just makes it so simple. He just gives you no fluff whatsoever, straight to the point, and it's so understandable. See, a lot of times all these economic terms are like Greek. I mean, people don't understand, and a lot of people are not analytical in mindset. But this makes it so simple. I just love it. And I
I
think
also
we can
read up
just
these.
promise, we promise that we'll bring it to you every 2 months now, not even every 3 months. I think it's going to be fantastic so that he can be really sharing with us all the great nuggets that he has mastered so that we can all really become very financially savvy in doing the markets, changing of the markets and investing in stocks and all, along with real estate, because real estate is a direct. Thank you,
You're
Amit.
absolutely
Yeah,
right. And I was in the same boat, right? Like when I read articles, I read so much fluff on the internet. Sometimes, unfortunately, even some prominent analysts get it wrong.
yeah,
Now,
oh
I do want
yeah,
to say there's nobody has a crystal ball. Everybody's
no,
basically making their assumptions based on their past experiences. This is how I view the market. That's why I'm
mhm,
saying I'm not telling people to go buy anything.
no,
I'm sharing how this is my view. This is how I see it. I base it on facts. The facts are right in front of you. This
yep.
information is freely available to you,
Mhm.
right?
Totally. No, and I love the clarity. I like the simplicity, and I love the each and every graph you've covered. It's so succinct. Thank you so much. Yeah.
So now everybody's going to say, Amit, how is the market going to perform this year? So
Yeah.
I have a chart that shows you the average performance of S&P 500 in all
Yes.
election years since the year 1950. And you're going to notice that the summertime is typically supposed to be a rough patch, right?
Mm.
And there's supposed to be an increased volatility, and volatility remains all the way till election occurs. And typically we know election occurs around 1st of November. So till then, there is typically supposed to be volatility. And after that, market grows, which is called the Santa Claus rally. Now, for long-term investors, many opportunities are going to come to pick stocks of great quality companies this year. But remember,
Mhm.
don't just invest your money in any stock. Invest in stocks of great quality companies that have a wide economic moat, which means they have a huge barrier to entry from competitors, that they have strong financial statements. And remember to pre-plan your allocations. So do not over allocate in one stock.
Yes.
And your investment process ultimately is highly important. If a good investment process you've thought through, you're going to keep making money. I see that in my portfolio regularly, right? It just continues to grow. And whenever the market takes a dip, I'm like, hey, I'm sitting in cash. Now it's time for me to enter. Throughout this
Yes.
year, I had very few opportunities to enter. But last week, market just took a great turn. I was like, hey, time to go buy. It's on Christmas sale right now.
I
So
love
I
it.
went shopping.
Uh,
So carry on with this. And any viewers who want to better learn how to invest or follow my views, like I have a free channel. Just join me on Amit Chandan Financial Knowledge. I have on every one of the slides at the top, I've written the Facebook group.
yes, I'm so happy. And you know what? I would love maybe as follow up with this one in about even 2 weeks, we could talk about what companies should, how to determine, what big companies one should be looking into, analyzing,
Yeah,
and
I
then
can definitely
making their
share
own decision. I
the
would love
mechanism of
that.
analyzing. Absolutely.
Oh,
There's a
I
whole
would love that.
science and math to it. There's some key
Yes.
fundamentals everybody's got to remember. And if you follow those fundamentals, which are easy to at least start getting an idea of, and then you can go into deeper study, because this is a vast field and Wall Street is full of very educated people. So it takes time,
Mhm.
but yes, I'd be very happy. And this is my passion.
That'll be fantastic. That'll be great. No, I can't wait. I know for the last 6 or maybe a year, we've been thinking about doing joint videos, cast and everything, and putting them into a reservoir where it's a knowledge base, which you are already doing it in the Facebook and YouTube and everything. And we could even promote that on both the sides, your
That's so
channels
kind of
and
you.
yeah, no, it will be
Kind of you.
my pleasure because I've got a lot of following as some in every channel. So no, I'm very excited about it. This is, and I'm learning in the process. I feel I've made good money, but there's always room to grow and understand the semantics.
Another reason of the market distress can be attributed to the uncertainty in how the US elections could turn out. Remember, the
Hmm.
stock market does not like uncertainty. And uncertainty in the stock market exists in the short term, right?
Yeah.
Until very recently, it was looking like Donald Trump was going to be the clear winner of the United States presidential elections.
Hmm.
But
Hmm.
ever since Kamala Harris came in the picture, the certainty of Donald Trump winning the election has eroded. Now, I'm not saying one is
Yes.
going to win or the other is going to
Yes.
sing. I'm just saying the certainty has eroded. And stock market hates uncertainty.
Aha.
But let's not go into predictions. Let's look at how the markets have behaved in the past since 1957 all the way until now. So from 1957 until 2023 under Democratic and Republican presidents. And what has the returns of the S&P 500 been? You'll notice that the stock market on average under Democratic presidents returns an annualized return of 11.4%.
Ah.
Okay. And while the same S&P 500 under a Republican president returns 7% annualized.
Wow.
So while, yes, market doesn't like the uncertainty, it doesn't really matter who comes. But let's say even if Democrats end up winning, nothing to worry, folks. The stock market is going to go up and it may even perform even better.
Yes.
And that's what the history has to show.
So in other words, election year, which comes like every 4 years, we can really expect the market to take off. That's what it's saying?
So no. So how the market behaves in the election year is marked by this chart, which shows me the average of how the election year, how the S&P 500 performs in election years since 1950. And what that shows is market has typically an upward trajectory until summer, then a sideways trajectory in the summer, and then it picks up. And sometimes even, and towards September, October, it even takes a heavy dip. But after the election, because the market has now understood the certainty, it knows who is in power. And so when it knows who's in power, the market basically goes off. And typically towards the end of the year, this time is called the Santa Claus rally. And what is Santa Claus rally? Santa Claus rally is basically a time of the year where people like you and me and everybody else goes and buys Christmas gifts and spends a lot of money in the market. And when we spend money in the market, companies make money. And when companies make money, their returns become better and their stocks go up. And that's basically what happens in the market. Now, you cannot essentially time it by the exact week because it's never going to be identical. This dotted chart that I have is an average. So sometimes a certain growth may happen a month after, a month before, and same thing with dips. Like this year, instead of a growth in August, there was a dip. So maybe it was this dip that happened earlier, or maybe this dip that was supposed to happen previously happened now. Nobody really knows that. But what we got to understand is volatility occurs to embrace volatility. And as long as you know how to select stocks of great quality companies and be able to mathematically calculate what the fair market value is, you will know what to buy and when to buy. From all the people that I run into, 98 to 99% have no clue how to calculate the fair market value of a stock. They have no idea what net present value is. They have no idea what discounted cash flow is. They have no idea how to value banks. You got to understand these things. People ignore finance, but everybody wants to make money and have their wealth grow. How can your wealth grow if you don't know finance? Right? You've got to understand this stuff, or at least some basics you got to understand. Now, going back to the next chart where you asked me a question, this chart doesn't represent the performance of S&P in election years. It represents how the market does every year under presidents of different parties. So if we have a president of the Democratic Party, on average, S&P returns 11.4%. And these are the averages that have been there since the year 1957. I haven't made this chart. I just got it from Motley Fool.
Surely, yes.
A president under Republican Party, if that person comes into power, then the S&P 500 returns on average 7% a year.
Got it.
That's what this chart shows.
Yes. Perfect.
Now, remember, I was telling you that the stock market is highly emotional and irrational in the short term. And it ends up getting spooked by many number of reasons, or any number of reasons. But in the long term, the stock market grows to reach its fair market value. And the fair market values are calculated on the basis of companies' earnings. So I have a chart here that shows you the earning insights of the S&P 500 companies in the second quarter just ended. The green here represents all those companies and the percentage of those companies in the sectors that have beaten analyst estimates. The yellow represents when it was in line with analyst estimates, and the red shows that these companies did not meet the
Below.
analyst expectations. And right
Yes,
here is
yes.
S&P 500. And you'll notice in S&P 500 that 78% of the companies beat analyst expectations. 78%. And in line were 6%. So 78 plus 6 is 84. That means 84% of the companies either beat analyst expectations or met analyst expectations, leaving only 16% of the companies below analyst expectations. So if the companies continue to produce good earnings, their fair market values are going to grow.
Yep.
And if their fair market values continue to grow, then invariably in time, the stocks of those companies are going to get there.
Surely,
Okay?
surely.
And if you, for those of you who want to, pause and review this carefully, you'll notice that each of these lines is represented by sectors. So first, the healthcare sector, then the real estate sector, industrials, financials, utilities, then S&P 500 as an average, generic, materials, information technology, energy, staples, consumer discretionary, and communication services. That's what this chart shows. It's freely available on Earning Insight that you can go and get. Now, lastly, we have to remember how the market typically behaves. The market never goes up in the straight line. You'll never see the stock market do this. It always goes up and down and up and down and up and down. When it goes up, you've got to know that it's now going to go down. So wait for the dips. What a lot of people do is they buy stocks when it's high because there is euphoria in the market. And they're like, the basics. Okay. So if I consider this line in the middle to be the intrinsic value, what happens is stocks reach that and then they go above. When they go above, it's called overvalued. When it goes below, it's called undervalued. So stocks always go up and down and up and down. And there are patterns that are predefined, or basically I should say there's statistical analysis that has already been done. And what these things exist, or what the analysis says is average frequency of these kinds of dips. So a dip that is 5% or more, or 5% and less than 10%, happens about 3 times a year. And their average length is 43 days. And a dip of 5% or more, but less than 10%, occurs 3 times a year. This time, the S&P 500 went down by 9.7%. So it fit right here. It's not even a correction, it's a dip. Between 10 and 15% is called a correction. And that is 10 to 15%. It happens once per year. Okay.
Wow.
A severe correction is 15% to 20%. So here's a severe correction. This happens once every 3 years. And a bear market is anything over 20%. And that happens once every 6 years. We just came out of a bear market and we're seeing our first dip. There are chances of 3 more of these in a year if you look at statistics, probability and statistics. So that means we'll have more opportunities to pick up stocks at Christmas sales, which I call Christmas sales because they're dips.
Yes, so, but this 42 days, 43 days, 110 days, and 251, I'm thinking that's a long time.
That's right. That's right. And I would say,
how should investors look at it then?
I think some of the major dips that happened in 2008, 2002, those lasted for a long time. They may be skewing the numbers, but I think recognizing that these dips happen frequently is very important. Now, how you deal with them, I'll tell you how you deal with them. So let's say the stock market is going like this, right? And suddenly a dip comes and it goes like this, it goes like this. What you got to do is called portfolio management and allocation. So if you have, let's say, 20 stocks in your portfolio, that means every stock is going to have 5% allocation. You never allocate 5% in one shot. You say, I'm going to do maybe 3 of these purchases a year. So every quarter, you can just start putting in 1/3 or 1/4 of your money that you had pre-allocated to a certain stock. Then if a dip occurs, you're just getting a larger volume. This is a very simple way of what's called dollar cost averaging. Just keep doing that, click, click. And if a dip occurs for a longer duration of time, you're just going to get a higher volume of those stocks. When you get higher volume at lower cost, your average cost per cost basis, ACB, goes down. And when the market picks up, your cheaper stocks grow and your total portfolio value grows. That's basically how you take advantage of it. You also have to be able to pick up stocks of good quality companies because to say cheap junk is just junk. If you say, oh, the stock is really cheap, I'm going to buy. If it's junk stock, it's just junk. You're accumulating junk. So learn to figure out which are great quality companies, and their mechanism. There's a whole process to identifying that. There's math behind it.
Wait, and we're going to do it. We'll set up a time maybe 2 weeks from today so that you are ready. And then we'll do another edition. And you know what, to be truthful, I think this is so good knowledge. I know I teach and talk and everything about real estate, commercial real estate, and hotels and multifamily, now senior assisted living, residential assisted living, all that. But people's net worth is in the stock market. $39.9 trillion.
That's right.
Are in the retirement funds, close to $40 trillion in retirement funds. And that's what you're talking about right there.
Right. And if somebody goes in, they have their 401ks, IRAs, majority of them, they're going to the stock market. And most of the people have no idea how to take advantage of the stock market. They depend on fancy financial advisors in suits and ties. Whereas if you as an investor are the best person to take care of your own financials, learn a little, and you can do a lot better. Join my Facebook group, which is Amit Chandan Financial Knowledge, and I share all kinds of information on a regular basis.
I hope everybody does that. Maybe I'm already there. To Facebook right there. Yes. So that's fantastic. I will be. So Amit Chandan Financial Knowledge, guys. And also Amitji has a YouTube channel also, really big. And also on the Facebook and LinkedIn also. People can find you there
LinkedIn,
too, right?
Instagram. But if you just go to my Facebook, from there, people can get everywhere. So I just kept it very simple.
That. It's fabulous. What else do you in store? So many great nuggets you have given this morning, Amitji. I'm really thankful to you. I know lots of people will be joining your Facebook group and will be interacting with you and I. And let's make sure that we are able to teach. Again, these are only the views of Amit Chandanji and myself. Myself, very little here. But Amitji, but remember, risks are always there. And we do not promote anybody buying stocks or this entertainment purposes only. I want to qualify that so that no lawsuits come and so forth. I just want to say that I've learned so much where the market is, why it's behaving like that, where the interest cuts will be coming, which is on everybody's, not in my seminars. I do. A lot of people ask me, so I'm going to send this episode to all of them because they need to be watching this and really getting into the driver's seat with what's fixing to happen with the lower interest rates. It will be a boom for the real estate and for all the people who are in distress and other things like that. That's going to help a lot. And not only that, picking with the dollar cost averaging, the stocks which will be going for Christmas sale. So would you wait? I've got a question for you. Today is like August 13th. So should we wait a little bit more for it to come down?
It depends on a person's goal, right? Some people may say, I want to invest for long term. So I want to, somebody maybe 40 right now and say, by the time I'm 60, I'm going to take out money. As long as you know what to get, and if you know that the fair market value of that stock is below its current trading price, and you know that you've already created a list of stocks and you know how many you're going to allocate and how much you're going to buy this time, right? There are many, because risk management is number one. As long as they know that, I think now could be a great time to acquire. Today, the market has jumped a little. So you got to analyze those stocks and say which ones are still underpriced or fairly priced.
Surely. So true. So true. Can I also talk about in the last 3 weeks, it's been a downfall. Almost some portfolios went down 20%.
Yes.
Why especially if you had happen? That's spooked the market so badly. Yeah.
So your question is, why did that happen?
Yes.
So my understanding right now is it happened because of the higher than expected unemployment rate. So the bad data that came in. It happened because of the Japanese yen and its interest rate prices.
Yes.
And this recession indicator that went off. So these were the key reasons that it happened. Now, the third reason why it was likely to have happened was because the market was trading too high. So a dip was inevitable. A lot of stocks in the S&P 500 were trading above their intrinsic values. And they had to come down because it's like a rubber band. You just extend and then it collapses back. So that's what happened. I was watching the stocks go up and I had the fair market values of a lot of companies. I was like, there's not much of an opportunity right now. I made some purchases in January this year, and then now. I bought nothing else in between.
Wow.
Because I don't, that's just the nature of my portfolio. Now, other people may have different portfolios. Some people's portfolios may have dipped by 20-30%. That depends on what kind of stocks they had. If they had highly volatile stocks, such as cryptocurrencies, then yes, if your stock was in Ethereum, you may have seen a 40% dip. But if stocks in more defensive categories or healthcare may not have gone down. Now, to understand which ones you would have invested in, if our viewers go back to my previous podcast with you, I had shown performance of different sectors. And sectors that had done really well last year, naturally, they may not have done that well this year. And that's what happened.
I'm so glad you brought it up. This is the one, guys, we were just talking about. Please go back and look at this whole. She gave so many great nuggets. It was mind-blowing.
It was just 2 months ago.
2 months back, and it's so much knowledge. It's just fantastic. I hope everybody really gets to see. Amitji brings fantastic graphs and everything, just like this one. Let's see here. It's going to come. Oh, look at this one here. There. So there is so much going on. Amitji is so much knowledge guru that I just totally, and in simplicity, he's able to explain all these things. So please go back and look at this episode also. We'll put the link right below so that you can really learn a lot as we do these sessions, maybe on every month, maybe we should, and that'll be fantastic. So I'm really thankful to Amitji. Amitji, thank you so much. I'm going to go back over here. Unshare so that people can see us right there. Thank you for all your knowledge, and it's been such a pleasure to have you. Thank you, guys. If you really like the episode, please share, comment, and share the knowledge with other family members, other people in your companies and everything who can really take care of their retirement funds and everything in their investments and savings to get better returns. It's not good to just keep the money under the pillow or putting it into a bank account with 2, 3, 4% interest. Great things can happen. Again, this is an educational show. We are not promoting any securities or any investments or anything like that. It's for educational and entertainment purposes only. Amitji, thank you. And please say again, how can people reach you in Facebook? With the
Facebook, my handle is Amit Chandan Financial Knowledge.
Amit Chandan Financial Knowledge. Fantastic. See you in the next episode.
Be sure to listen to Mr. Smiles next week with more golden nuggets and top-notch coaching tips. You can reach him by going to VinneyChopra.com. Be sure to like, comment, and share to show everyone how Mr. Smiles has brought your apartment syndication business to the next level.